Welcome to my brand new show, Monetary Matters. We are beginning it on a historic day, Wednesday, September 18th. The Federal Reserve has cut interest rates by 50 basis points. It started off with a strong double interest rate cut. And the last time they started a cycle with an interest rate cut, I believe, was 2007. And I have the perfect guest. I'm going to be speaking with Joseph Wang, who on my previous show, Forward Guidance, where some of you may know both of us from. Joseph led us and he did right by me and our viewers, served us well in terms of being a guide on what the Federal Reserve would do. Jay Powell just spoke, so we have a lot to get to. Now, welcome to Monetary Matters.
The ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
Thank you. Just close the door.
All right. I'm here with Joseph Wang from FedGuide.com. Joseph was a senior trader for the New York Federal Reserve and is an expert on all things Fed. Joseph, what did you make of today's Fed meeting, the 50 basis point cut, the dot plot from the summary of economic projections, as well as the press conference?
Well, first off, Jack, congratulations. I love the intro and I learned so much in Forward Guidance. I'm so glad I've subscribed to your channel and it's an honor to be the first guest here. Now, going to the Fed, well, this is actually the most exciting Fed meeting we've had in some time. As we've discussed before, the Fed doesn't like to surprise the markets. So every time we have a Fed meeting, it's well telegraphed in advance what the Fed will do. And people thought that this one would be the case as well. So heading into the Fed's blackout period, which is the period where the Fed speakers no longer make public statements, the market was pricing in about a 25 basis point cut today. Now, that was based on Governor Waller and President Williams, open to large cuts, but not really pushing for them. Now, a few days before, there were some news reports that suggest that maybe the Fed is more inclined for 50 basis points than the market was pricing in. And immediately the market leapt into action and began pricing in a pretty high probability of a 50 basis point cut. Now today, the Fed delivered, and it wasn't a sure thing. We were pricing in 40 basis points, but the Fed did deliver a 50 basis point cut. So that was, boom, the beginning of the cutting cycle, as Chair Powell promised since his Jackson Hole speech. The time has come, but also a larger than expected, or larger than usual cut. Now, what stood out to me, though, was the rationale for the cut. So why is the Fed suddenly cutting in such a big way? Now, Chair Powell seems to point towards the labor market. So over the past few years, inflation has been the Fed's primary problem. Inflation was much higher than 2%, but over the past few months, it's gone down a lot. But what's gone up a lot is the unemployment rate. So more recently, we're at 4.2%, but before that, we were at 4.3%, and that seems to be too high for comfort. Now, the Fed has been looking at a lot of indicators in the labor market, from the Beige Book, from the most recently revisions, where we found out that the jobs created last year were actually, let's say, we revised away about 1 million jobs, and so the labor market was not as strong. Looking at other survey data, looking at, for example, the Challenger survey and so forth, it seems like the labor market really is weakening. And so it seems like the Fed is trying to get ahead of what could potentially be a recession and try to cut rates by a lot. Now, looking at the dot plot, what really stood out to me was that the Fed notably revised up its unemployment rate going forward. So that again confirms that they think that the labor market is going to weaken more for the next actually several months. And so they want to be in a position to support that in the event that we do go into recession.
I think that's the point I want to hammer home for the audience, is that the Federal Reserve is concerned about the labor market. They're never going to use the word concern or worry. They prefer to say it's something that they're watching very closely. And that is the key point. But I'm surprised to say, Joseph, that you thought that they did revise the unemployment rate up in terms of projections. But surprised to hear you say that you think that they surprised them up by a lot, because I was struck by how little they revised them up, because the unemployment rate has gone up from a single month from 4.1% to 4.3%. It's actually less than 20 basis points if you go into the second basis, the extra decimal point. But let's look up here, the first red box. So in June, they were projecting by the end of the year it to be 4.0%. And you're right. So they revised it up from 4.1% 4.0% to 4.4%, but the actual unemployment rate has gone up from 4.1% to 4.3%. And in June, it could have been at 4.0%. I don't recall, to be honest. But to me, Joseph, these unemployment rates forecast seems quite low. So basically, what they're forecasting is that the maximum unemployment rate for this entire cycle is going to be only 10 basis points higher, which to me seems like it's a pretty they're taking a lot for granted. I mean, I think that if the unemployment rate goes to 5% and it peaks at 5%, I think that would be great for the economy in terms of it not going higher, because still 5% is a decent labor market, and then we can start a new cycle, and that's great. I think. Would you agree with me that the Fed is taking stuff for granted, or no?
Well, Jack, you're absolutely right. I think the Fed has trouble to kind of forecast a recession, right? So now, to be clear, the Fed was forecasting 4.0% in June, and as you mentioned, it's at about 4.2, 4.3%. So they were already forecasting too low an unemployment rate back then, and now they could, with their 4.4% forecast, that could still be too low, right? So as we know from the Dudley rule, when the unemployment rate goes up, it tends to exhibit upward momentum. So what seems to happen is that when some people lose their jobs, then there's a lot less demand, a lot less spending. That means other people lose their jobs. And so there's this nonlinear impact historically, not necessarily always the case, historically, that unemployment rate tends to rise faster. And so the Fed could be behind in the Fed's projections could be too low again, and they could be surprised again. Now, one other thing I'll note, and Chair Powell noted this as well, is that this time, that one thing that's different this time is that part of the reason we have a higher unemployment rate is because we have more labor supply. As we know, there's a lot of more migration, and if you add a lot more people looking for jobs, that will mechanically drive up the unemployment rate. So there's some caution in looking at that. It could be a little different.
Joseph, we're going to get into your views. You've been a massive bull on stocks, which has obviously been the correct place to be. Your most recent article on fedguide.com says that actually a large rate cut, such as the one that we had, a 50 basis point cut, actually might not be so good for stocks. So I'm just going to tease that for the audience. But I want to ask you, Joseph, about something closer to home, which is the fact that you and I and most people, almost everybody, woke up today, perhaps even the Federal Reserve, woke up today not knowing what the Federal Reserve would do. Every single Federal Reserve meeting, the FOMC meeting that I can remember, Joseph, that I've been covering, has the day I woke up, I knew what they would do, and people paying attention, it wasn't that hard to know what they would do, because you just had to look at the forward market pricing. The Chicago Mercantile Exchange has a forecaster, and it would say in 2022, a 98% chance of a 75 basis point hike and a 2% chance of a 50 basis point hike. And obviously, you got to go with the 98%. And that was never wrong. This is the only time that I can remember. And I'm curious that we woke up this morning and it was pricing in maybe a 55% chance of a 50 basis point hike, a 45% chance of a single basis point cut. I said hike, I meant cut. Sorry. We are at the beginning of a rate cutting cycle. We just got out of the hiking cycle. So everyone, please bear with me. And when is the last time that you remember that Fed watchers woke up today being uncertain, and short-term interest traders woke up today being uncertain? And why do you think that is the case? I learned from you that Jay Powell likes to let the market know what is going to happen. That is the essence of forward guidance. He doesn't really like surprises. So is it a change of philosophy on that? Actually, let's leave the market guessing because they've been pampered with all this information and forward guidance? Or is it that actually there is severe disagreement at the FOMC? The doves and the hawks are fighting, and that is why we had a dissent from Governor Bowman, which is the first dissent from a FOMC board of governors since, I believe, 2005.
Yeah, no, I don't think it's a change in communication. So as you know, the modern Fed doesn't like to surprise markets. Once upon a time, the Fed did surprise markets. Famously, back in the days of Greenspan, the Fed would do something, and market participants wouldn't actually know if they hiked or cut. They would actually have to look closely into the interest rate markets. And some central banks today still like to surprise the market. The Swiss National Bank, for example, more recently, just would change their currency policy, catch a lot of people off sides, and basically shrug their shoulders and say, "I forgot to tell you." But the Fed is not like that. Now, the reason why that there was uncertainty heading into this decision is because I think that the Fed themselves didn't know. Now, the FOMC likes to have consensus. So notice that almost all the time, there's unanimous agreement on their decisions. Now, the way that this is achieved is that there is a lot of lobbying that goes down behind the scenes. So Chair Powell, as he said before, has numerous conferences with all the FOMC members before the meeting. So he wants to walk into that room having a good idea of what the decision will be. He doesn't want to be surprised. But for this particular meeting, though, you could have a good case for 50 basis point cut, and you could have a good case for 25 basis point cut. And he just wasn't sure what the committee would decide. So heading into blackout period. So I think that's the reason why that he also allowed news stories to leak that it could be 50, because he wanted to prepare the market to know that, they're not really sure what, so the market shouldn't be so sure about 25 basis points. Now, as you note, Jack, we had one dissent this time. It's the first Governor Bowman dissented. It's the first time a governor dissented since 2005. Now, Governor Bowen is a noted hawk. I actually think she's the most hawkish person on the FOMC, so it's not surprising that she would be the person who dissented. Now, when Powell was asked about the degree of agreement on the FOMC, I think that he suggested there was broad agreement. So my sense is that although Bowman was the only person who openly dissented, I think it took some politicking to get everyone on board. So there's probably a few others who are reluctantly voted for the 50 basis point cut. Now, looking beyond that, though, I think the dot plot suggests that this is a one-time thing, and the next two meetings will get 25 basis point cuts. Again, this could all change with the data, but I think right now the plan, according to the dot plot, is just to start with a bang.
Start with a bang, just like they did in September 2007. It's an interesting move. So it's not, you think that the next few cuts will be 25 basis point cuts, and it sounds like, are you confident that the next few meetings will be cuts? There will not be pauses. It's going to be 25 or 50, probably 25, but not 0.
So there are two ways to look at this. You can look at the dot plot, which strongly suggests we're probably going to get a meeting for the next two meetings, or you can look at what the markets are pricing. Now, the markets are much, much more dovish than what the Fed is pricing, what the Fed is guiding towards in their dot plot. The market is thinking we'll have 75 basis points before the end of this year. And looking towards the end of next year, the market is thinking we'll be below 3% by December of next year. And the Fed's dot plot is thinking we'll maybe be at 3.4%. So the market is pricing in a lot more cuts, back to its old habits of of being very aggressive. And as we've discussed over the past few years, Jack, the bond market has not been very good at guessing what the Fed will do. So we'll see if they'll do better this time.
We will. So you're absolutely right that this entire hiking cycle, the market always thought that the Fed was done hiking and that they would start to cut, and they were always way too early, and they always thought that the Fed would be way more dovish. But that was during a hiking cycle or during a pausing cycle. We are now in a cutting cycle. Is that a fundamentally different period where, just as the market was fighting the Fed's hawkishness on the way up during a hiking cycle, is it actually correct to price in a lot of dovishness during a cutting cycle? Because that's what a cutting cycle is all about.
So I think that really has to do with two things: just how strong the economy is and where the quote unquote neutral rate is. So looking first at the economy. Now, over the past 2 years, I've heard endless people with all sorts of prognostications saying that we are in a recession, and any moment now the data is going to be revised down and you'll finally figure out that the economy was in a recession. I mean, look at things like the yield curve or something like that. But looking at the most recent data, the GDP continues to grow above trend. Or most recently, GDP was revised upwards from 2.8 to 3%, comfortably above trend. Looking at the Atlanta's Fed Now GDP nowcasting, it looks like we are continue to grow at 3% as well. So it seems like the economy continues to do well, but I think there are major risks ahead in the coming months, and we'll talk into that later. But as Chair Powell repeatedly noted, just looking at the data as we have it today, it doesn't look like it justifies the degree of cuts in the price into the market. Now, the next thing is, how do you think about the neutral rate? And the neutral rate is basically the interest rate level where where the Fed is neither stimulative nor restrictive. So for example, let's say the neutral rate is 4%. That means when the Fed sets interest rates above 4%, it's slowing the economy. And when the Fed sets interest rates below 4%, it's stimulating the economy. So the market and the Fed are both struggling to figure out where that neutral rate is. And once they know that, they can kind of calibrate the path of policy. Now, looking at the market pricing, it looks like the market still thinks that the neutral rate is really low. And so maybe the market thinks that even if we cut rates to 3%, it won't really be very stimulative because the neutral rate is very low. Chair Powell gave a really interesting comment today that he thinks that the neutral rate today is significantly higher than pre-pandemic. And so that suggests that according to Chair Powell, rates probably won't have to be cut as deeply as they were before. And so that probably is why they're thinking that they'll be at 3.4% at the end of next December, rather than, say, 2.8% as the market is pricing in today.
Just to put that dot plot back on screen, the forecast of where interest rates would be is well below where the Fed forecasted on the last dot plot in June. And so it seems pretty dovish to me, forecasting 4.4% for 2024, 3.4% at the end of 2025 versus 4.1% as it was end of 2025 was forecasted in June. That seems pretty dovish. Now, it's not as dovish as the market is still forecasting. So there's still a difference between where the market's forecasting. I'm just looking at Fed funds futures for the end of 2025, and that has it at roughly 2.9, 2.88%. So that's still well below the 3.4% that the Federal Reserve is forecasting, but they're getting into closer balance. So Joseph, going in, there was a perception that, well, it doesn't really matter how much the Fed is going to cut. If they do 25 or if they do 50, it's going to be a similar amount of dovishness or hawkishness. In other words, if they're to 25, there'll be a dovish 25 cut. If they do a 50 basis point cut, it'll be a hawkish 50 basis point cut. So the effect on the stock market and the short-term interest rate term structure of the bond market will be the same. I might say that this was a dovish, or at least not a hawkish 50 basis point cut. Would you agree with that, just based on the dot plot?
Absolutely. Absolutely. You have major downward revisions in the path of Fed policy, like you just pointed out, and notable upward revisions in the unemployment rate. It's definitely a dovish dot plot, dovish conference. There's no doubt about it. Now, what's really interesting to me, though, was the market's reaction. Now, first off, the immediate reaction was, well, the Fed the pricing in an even lower, let's say, December 2025 Fed funds rate, like you mentioned, to 2.8%. But I noticed, though, that as we're recording this, it seems like the longer dated interest rates rose. So the 10-year and the 30-year interest rates actually rose. And that suggests to me maybe the market might be concerned somewhat by inflation accelerating later on because maybe the Fed is cutting too much too soon.
Right. And you had a piece that came out 2 days ago on Monday. All your pieces come on fedguide.com on Monday. And your piece was called When Big Cuts Are Bad. And it was about how actually a 50 basis point cut could not be great for the stock market. Interestingly, the S&P is down as we record this after a 50 basis point cut. Tell us about how you arrived at that view.
So I think looking at the stock market, so at the end of the day, prices are just supply and demand. People buy and sell for very different reasons. Now, there's a presumption, I think, that when interest rates are low, stock prices go up. It's positive for asset prices, and that's totally true. We've seen that happen over and over again for the past, as long as we have had interest rates. But that's not the only thing that matters. One of the things that I've noticed is that, and this is highlighted again through the collapse of the yen carry trade we saw a few weeks ago, is that foreigners are increasingly large participants in the US equity markets. And from their perspective, they also care about the currency aspect to it. For example, let's say they buy US stocks, it goes up 10%, but if the dollar weakens by 10%, then they're not really any better off. So there's that extra lens of currency that matters to foreign investors. Now, when I look at the data, it looks like foreign equity holdings, the equity holdings of foreign investors are the highest they've ever been, and they hold about 20% of US equities. Now, for them, of course, the US equity market has done really well. So it's a great trade. And the US equity market has like these really awesome companies, particularly exposed to AI, like NVIDIA, Mag 7, and so forth. So when you look at sovereign wealth funds, say the Norwegian sovereign wealth fund, their top equity holdings are actually all US technology stocks.
Their top 6 stocks are all, right?
Yeah, they love the Mag 7. And the Swiss National Bank owns a lot of US tech stocks as well. So everyone likes US tech stocks. And indeed, it's been a great trade. I'm thinking of it from their perspective. Dollar strengthens over the past few years. And of course, the Mag 7s have done well. But right now, though, if we have big cuts, we could have a situation where the dollar actually weakens a lot. And in that case, all these foreign investors, they're going to have losses through their currency exposure to the dollar. And that might change their calculus and encourage them to sell. Now, the way that I look at the US dollar is one of the determinants, of course, in addition to short-term interest rate differentials, is, of course, the fiscal deficit. When you have a large fiscal deficit, you are basically printing dollars, right? Treasuries are just dollars that pay interest. Now, the US has a very large fiscal deficit. The IMF is projecting that it will be about 6% a year for the foreseeable future. In comparison, the other developed company peers, it's about 2% a year for the foreseeable future. Some a little bit worse, of course. So there are depreciatory pressures on the dollar from our fiscal situation. I think that's been held. The dollar has been held up by really high interest rates. Again, dollar interest rates have been higher than many other developed countries. But if we have these aggressive rate cuts, you can easily be in a situation where massive fiscal deficits plus low interest rates plus maybe a potential recession, that could be a recipe for significant dollar weakness. And you could have a lot of foreign investors who want to sell to get ahead of that FX currency losses that it'll experience. So, that could be really negative. And, we see something like that happen in other markets, mostly emerging markets, but I think the dynamics are set up so it could happen here as well. I mean, just look at the fiscal management of the country and look at the exposure of foreigners to US equities. So I think that's something to be cautious. So I'm thinking that maybe, again, the bigger picture, large fiscal deficits, upward pressure on asset prices and so forth. But I think we might have to wait until this position gets adjusted. So maybe the crash up, which I've been in for most of this year, we'll have to wait for a little bit.
And what specifically about now is making you a little bit more cautious on the stock market? Basically, as you said, the risk that as U.S. interest rates decline and the U.S. fiscal deficit continues, the dollar will weaken, and foreigners, let's say someone in Japan owning a U.S. dollar asset, if the yen strengthens against the dollar, they wish they owned the Japanese stocks instead of American stocks, and that could force a liquidation. And I'll also say that a lot of when it comes to bonds, a lot of foreigners hedge their currency. So, for example, Japanese government bond yielding 1%, the 10-year yielding 4% in America. Oh my God, that's such a great deal for a Japanese investor. Well, actually, if you include the hedging costs, it's actually can be negative. However, as you pointed out in your piece, research indicates that foreigners, when they invest in American equities, don't hedge. So actually, this is a risk. But my question is, Joseph, why? What about now? 6 months ago, many percentages on the S&P 6 months ago, this argument could also have been true, and yet you didn't put much weight in it. Why are you putting weight in this now? Why are you taking this as a risk right now, September 18th?
Because, a couple of things. I think one is that we are beginning a rate cutting cycle, and it's a rate cutting cycle that the market anticipates to be pretty aggressive. Now, when the market, let's say earlier in the year, in January, when the market was pricing in 7 rate cuts this year, we also saw a notable weakness in the dollar. The Dixie was at around 100. Now today we're in the same situation. Actually, it looks like the dollar index is around 100, and the market is back to pricing a lot of rate cuts. So I think the difference is I actually do think we have a good chance of having a lot of rate cuts, good chance of falling into a recession later on. So this is becoming more salient. And the second thing is, we had that episode in August where we had suddenly a reversal of the yen carry trade. Of course, there were other things going on as well, blowing up of the dispersion trade, short vol and all that. But from a Japanese investor perspective, the yen has strengthened 10% in 3 months. And so if you're a Japanese investor in US stocks, that's been painful. And I think that is making it more aware to market participants that this is something that could happen, that this big gravy train people have been riding the past few years, appreciation US equities, appreciation US dollar, could reverse. And so I'm thinking that since people are more aware of this possibility, they might be more sensitive to further dollar depreciation.
So, Joseph, if for all of 2023 and most of 2024, you have been an indefatigable equity bull, are you now bearish on stocks, or are you less bullish, or are you neutral? Are you cautious? What adjectives would you use to describe your outlook and your positioning in the stock market right now?
Yeah, I'm bearish and bearish / very cautious. So what I would really feel more comfortable with is we had a lot more clarity on the direction of U.S. Policy. So the way that I look at the world, public policy is the most important driver of asset prices. You can think of it in terms of fiscal policy, where we know you could give money to a whole bunch of people. That is positive for the economy. You could cut taxes bigly, and we saw equities respond strongly when President Trump did that. And we can also think of it as monetary policy, right? So Fed does this, Fed does that, and it oftentimes has an impact on the financial markets. Now, all that is public policy. Now, we're heading into a situation where I think there could be a pretty big divergence in policy depending on who wins the White House after November. And so that makes me pretty cautious. And I think that makes a lot of businesses cautious as well. Now, there's a lot of survey data that suggests that businesses, they're having trouble making long-term plans because they don't really know what the world will look like. And that is going to have a chilling effect when it comes to hiring and when it comes to investments. The Challenger survey, which is a survey that surveys a whole bunch of companies about their hiring intentions, recently noted that they found that their survey shows that hiring intentions are the lowest that they've ever had in their survey. So I think there's a lot of uncertainty that's going to have a dampening on the economy. But more importantly, I think we could have very different visions of the world. And until I get more clarity as to what the world would look like, I don't think that I would be comfortable in equities.
And so how much of your lack of comfort in equities, cautiousness on equities, is due to the upcoming U.S. presidential election? How much of it is due to these carry trade interest rate differentials that you've cited? As the dollar sells off, foreigners will sell their U.S. stocks. And how much of it is to do with other factors? It's the U.S. stock market is quite expensive on a historical basis, and the labor market is slowing down. We could be entering a recession, other factors.
Yeah, so I don't really look at the world through things like valuations. I mean, you could have PEs or whatever, and if you look at a chart, things that are expensive by whatever metric can continue to be very expensive, and things that are cheap on whatever metric could continue to be very cheap. So it seems to me that's not super useful. So again, I think of things more in terms of policy. Now, I think having a depreciating dollar and very dovish monetary policy, that all is actually connected to what could happen after November, because you do have one of the presidential candidates who would like to have more control over monetary policy and maybe have some influence on the dollar. And that is, to be clear, totally within the purview of the executive branch. So that's one thing. And another thing, I think, just thinking about macro and inflation more generally, one of the big changes that we've seen over the past few years is the executive branch's willingness to basically change the supply of labor in the U.S. economy. And that has been positive for GDP growth, right? One of the reasons why we have above trend GDP growth is because we have more people working, right, by several million. And on the other hand, one of the reasons why we have inflation that's stubbornly above 2% is because of shelter inflation. And that's also related to having more people in the country looking for places to live. You see the same thing happen across the world. In Australia, they actually haven't cut rates. Inflation remains around 4%, largely because their rent inflation is through the moon, because they increased their population by almost 3% in a year. In Canada, same thing, increased their population by about 3% a year, tremendous increase in shelter inflation. So depending on what happens with immigration policy after November, you can have a different dynamics that impact inflation and impact GDP growth, and how monetary policy reacts to that. That would also be in part a political decision. So there's just a lot of moving parts that could, I think, have really big impacts on the economy and markets that I think really merits caution until we have more clarity.
And when you said that one of the presidential candidates favors the presidential involvement in the Federal Reserve's monetary policy, I presume you're talking about former President Trump, who, when he was president for the first time around 2018, he, I believe, said on Twitter that Powell needed to cut rates or stop hiking rates at the very least. And he has sounded off again that he thinks that interest rates should be lower, and his background in real estate may explain a potential favoring of low interest rates. So if President Trump got reelected, he might call on Jay Powell to lower interest rates. Powell was asked about that possibility today. I think he pretty artfully dodged that question. But how do you take that as someone who used to work at the Federal Reserve and someone, an institution that prides itself on central bank independence, on not taking directions from either party, and supposedly doing purely what they think is best for the economy according to their dual mandate of stable prices and maximum employment?
So the Fed is run by people, and people are not angels, right? They have their own beliefs, their own biases, their own preferences. Now, one way you can see that is looking at former President Dudley of the New York Fed. He used to be the second most powerful person in the Federal Reserve. In 2019, he wrote an op-ed in Bloomberg suggesting that the Fed should conduct monetary policy in a way that could prevent Donald Trump from winning the White House, right? So there's this guy who used to be super important, basically openly being very political. Now, if you look at the public donation data in the Fed, you'll notice that almost everyone who works at the Fed donates to the Democratic Party. So the Fed is we want to think of them as an independent institution, but they're very much, they are people and they have their political beliefs, and it's strongly tilted towards one side. So even though we say that, Donald Trump wants to have more influence on the Fed, well, the truth is that the Democratic Party already has tremendous influence on the Fed. They don't really need to do anything. Another way you can look at this is how they make the trade-off between, say, inflation and unemployment. Whereas I think the conventional thinking is that the more left-leaning you are, the more pro-unemployment, the more you place emphasis on the labor mandate. And that's certainly true with what happened with President Biden. When you look at his appointees to the FOMC, they don't really have very strong credentials in macro, but they're very strong credentials in labor. And that could partially explain what we see today, where we start with a big bang, a 50 basis point cut, and a very, very high emphasis on the unemployment side of the Fed's mandate. So, I would say that no matter who wins the White House, you're going to have a political Fed. It really just depends on how political they are.
Right. Well, thank you, Joseph. So that is an excellent point. I've seen the data you cited, and I think what you meant. I think you said that the vast majority of people at the Fed contribute to Democrats. I think what you meant to say is the vast majority of people who contribute to a political party contribute to Democrats. That is definitely true. Do you have a sense of how much of that are the staffers who produce very detailed research, but they don't have a vote, versus the actual members? And maybe I'm foolish because I believe in central bank. I believe they do have the political affiliations, and they are doves, they are hawks, and they are chosen by a Democratic Party or the Republican Party or the combination thereof. But I don't believe that the majority of FOMC participants are I'm going to cut 50 basis points to help Kamala Harris or help Joe Biden. Would you agree with me there, or would you think I'm foolish and that actually that it's a little more dark? It's darker than that.
I agree with you. I think the bias is not so much that Okay, so let's be clear now. Remember, former president of the New York Fed, William Dudley, wrote an op-ed saying that we got to do something to get Donald Trump, and so make sure that he loses. Okay, so there are people there who do that, to be sure. Now, for the most part, I agree with you. People there are not trying to rig the game in favor of one person or another. But I think the bias comes into how they perceive the world and how they make the trade-offs. Now, remember, the Fed has this dual mandate, and and they don't have any instructions on how to weigh them. And so the bias has to do with, do you value inflation more, having low inflation more, or do you value having low unemployment more? And so that's very much a personnel decision.
Got it. Okay. And then what is your personal view on the appropriateness of the executive branch, namely the US president or people who work for the executive branch, to share their opinion publicly or even put pressure on the Federal Reserve to act a certain way, as former President Trump did in 2018? And although she's a senator, Elizabeth Warren did. She wrote a public letter to the Federal Reserve asking for a 75 basis point cut. So it definitely does happen. But what are your personal views on, how appropriate that is? I mean, it is true, after all, that central bank independence and namely the 2% inflation target, and we have to focus on this, was kind of pulled out of thin air. I mean, Volcker did talk on TV in the 1980s about how the deficit was out of control. I mean, these two worlds, they merge a lot more than is commonly thought, right?
No, you're exactly right. So I think Chair Powell, when asked that, he would say that, historically, if you look across the world, having an independent central bank has produced good macroeconomic outcomes. And that's true, but I would caveat that in a couple of ways. Well, first off, so what if a central bank does a bad job? I mean, if they are independent, then there's less probability of being able to replace people who are not suited for that job. What comes to mind is Mary Daly of the San Francisco Fed, right? So she's fully on team transitory, so she got that call wrong. And then she's also supervisor for Silicon Valley Bank. Now, they had access to all the books of Silicon Valley Bank and did a terrible job supervising them, and ended up watching Silicon Valley Bank blow up. Now, she's still there, right? There's no accountability and so forth. And that's true for basically everyone in the Fed. If you say that they are just independent, well, there has to be some mechanism for broader accountability. Which brings me to my second point. Now, the central bank is still ultimately serving the American people. There should be some mechanism where there should be direct accountability. Now, in the past, it may be surprising, but we actually had the Treasury Secretary of the US sit on the FOMC, contributing to their discussions. So that's one way we could do this. So I think it's hard to design a system where we can have a central bank that is not captive to politicians, so basically running policy to benefit people in office, but also making sure that we have a way for them to be accountable for decisions when they make big mistakes. So that's a really difficult design problem, and I'm not sure I have an answer to that, but I'm open to the fact that having the executive branch, which is of course elected by the American people, to have more say could be one way that we can have more of this accountability. So I don't know if it will work better. And I'm not saying that the president should run monetary policy, but it is a potential solution to what I see to be a lack of accountability for a whole bunch of people who, like President Trump has said, they never fire anyone. And so you don't really have any way to get rid of people who have bad judgment. And that's certainly my personal experience working at the Federal Reserve as well.
That is a really interesting perspective, and thank you for sharing that. Joseph, moving on, what is your economic outlook at the U.S. And for the United States right now? You acknowledged, as the Federal Reserve just acknowledged, the labor market is not as strong as we thought it was in 2022 and 2023, and it probably wasn't as strong then as we thought it was then. How seriously are you taking a risk of a U.S. recession? And how does that shape your outlook on interest rates and equities? Because I mean, if we're going to have a recession, equities are probably way too expensive, i.e., way too high, and the bond market's pricing in all these cuts is probably correct, and maybe they need to even price in more cuts.
No, I think there's a good chance we could have a recession starting later on in the year. Now, the way that I think about this is, rather than focus on things like interest rates, recession, I mean, if you're thinking about growth, things like that, that's ultimately coming from individuals working hard, either starting new companies or working more hours. And that has to do with their view of what the future will be, their confidence, so to speak. Now, I think we're heading into a period because the country is so divided that no matter what happens, about half the country will feel like the world is ending after the election. And maybe that will drag on for some months because maybe it's not a binary event. Maybe there's some litigation and so forth. So all of that, I think, is a drag on confidence. If you have a lot of people in the country who feel like things are not getting better, who feels like things are, dark skies in the future, I think that will impact their willingness to start new businesses, to innovate, to work harder. And that's going to be a drag on growth. Now, that's just on the domestic front. Looking across the world, you have very strong, I think, deflationary pressures emerging from places like China. Looking at the Chinese government bonds, they're making all-time lows. So it does seem like the global economy maybe is slowing a bit. And if you have all these forces, it could, of course, push the U.S. economy into a recession. U.S. economy is more insulated to global forces than other economies, but ultimately, we do see the trajectory as slowing. And if we're at this moment of fragility, you could have things happen that push it over. On the other hand, you still have very positive headwinds, large fiscal deficit, putting money into the U.S. economy, and of course, the Federal Reserve willing and able to cut rates significantly. So that is supportive as well. So right now, looking at the trajectory of everything, it looks like it's just going to be, I think, a lot of uncertainty for the next few months. But earlier in the year when we spoke, I didn't feel like we were going to be in a recession. We still aren't, but I think in the coming months, that is more of a possibility.
Right. And just to, explain to people keeping a scorecard at home, if someone forecasts a recession in 2021 and it eventually happens at the end of 2024, yes, they were right, but they missed all the, stocks going up along the way, and it's a moving target. So, you weren't wrong to say you didn't think there would be a recession, 6 months ago, because we haven't had a recession. There is a chance that we could already be in one based on the SOM rule. That is possible. But now you think that a recession chance is elevated, and it could appear as early as this year.
I mean, think about it from a policy perspective as well. Let's say that we have President Harris, and although unlikely, let's say that we have Democratic control of Congress, raising the corporate tax rates, raising income taxes, taxing unrealized gains. Those are things that I think everyone will agree. Maybe they're good for the debt. Maybe they're good for wealth inequality, things like that. But that's obviously not very good for business. Or growth. So, again, I think policy is the most important driver of the economy and markets. And we're heading into this event where we could have very different outcomes of policy. So I think that is reason. I mean, we could be in such a world where we just have higher taxes. And, I think that would not be good for growth.
And do you think that the deficit will be bigger under Trump, and therefore the economy will be stronger and the stock market will be higher under Trump?
So the deficit is going to be pretty large, regardless of who's president. If you look at the underlying drivers of the deficit, they are mandatory spending, so Social Security, Medicare. There are also things like the interest expense. Those things are the lion's share of the deficit, and they are going to continue to grow no matter who is in office. Now, the other stuff, the discretionary stuff, that is stuff like military expenditures, or you could think of it as like green expenditures, industrial policy. That's a little bit harder to say. President Trump is less inclined to have, a big involvement in foreign wars and things like that. He didn't start any wars, but I'm not sure if that would be the case under a Harris administration. Now, on the other hand, though, President Harris has been very vocal about raising taxes, right? So that would reduce the deficit, whereas I think President Trump would just like to have even fewer taxes than we do now. So that would be, again, less revenue for the Treasury.
And Joseph, I believe there was a time when you were quite bullish on the American home builders. I don't know how long you've had that position or that view. Home builders have gone up a lot, even as interest rates went up, largely because the housing market just didn't go down as much as you would think when interest rates go from 0 to 5.5%, or mortgage rates go from 3% to 7%. Now mortgage rates are going down, housing starts are going up. Are you still a bull on the housing, American home builders, even though you're cautious and maybe even bearish on the overall stock market?
I think real estate is going to do well. I mean, real estate, obviously, supply and demand. Let's look at what that looks like under either administration. Now, under Harris administration, I think they've been very open. They would like to have more migration. That's millions and millions of people wanting to needing some place to live, right? More demand. And I noticed the first thing Vice President Harris mentioned on the debate stage was that she wants to give everyone a lot of money to buy new homes. That's a lot of demand as well. So, that's a very strong policy that would be able to boost housing. I don't know if she could get the say 25,000 tax credit to home buyers, but I know the White House, as we've seen over the past few years, can unilaterally decide migration policy. Now, President Trump, again, real estate guy, really open to low taxes, really open to fiscal spending, likes lower interest rates. And one of the things that I've noticed in the legislation during the Trump era is that there's a lot of stuff that was friendly for real estate developers and housing, like the opportunity zones, which really promoted new construction development. So, yeah, I think that from a public policy standpoint, looking at a demographic standpoint, and looking at the trend of interest rates, right now we've had the mortgage rate come down steadily over the past few weeks. That should be suggest a strong housing market for the next few years.
Thank you, Joseph. And earlier you referenced the risks you saw on the horizon, and I believe you had a plural risks. So one risk is definitely this dollar weakness, stock sell-off. But outside of the stock market, are there any other risks that we haven't mentioned so far that you are taking seriously?
So one thing I think that it's very difficult to price, but what we do clearly see is that there is higher geopolitical risk. Now, today, what's on the news is that there was an operation where a lot of people with pagers exploded, right? And so that seems to be some escalation in Middle Eastern tensions. Just last week, one of the headline stories in Politico was that there was some talk of authorizing Ukraine to use long-range missiles to strike within Russia, and that was immediately followed by an interview from President Putin saying that if you guys do this, I'm going to think of Russia as being at war with NATO. Again, that is in the direction of escalation of conflict in Eastern Europe. So these geopolitical conflicts are I think things that are heating up. We've kind of gotten numb to them, and we don't really think about them anymore. But they're not getting better. And so you could easily go to a point where it just pops out of nowhere and the market suddenly begins to worry about it. Now, when I think back to, for example, the 2020 COVID days, we were seeing tremendous amounts of news flow in China about the virus, and the market never cared. And then one day, when I went to Italy, the market started caring, and everything kind of fell apart. So, again, the market is not really sensitive to things happening far away. And then one day it suddenly is. So I think that's something to be mindful of.
That makes sense. Joseph, I now want to turn to something that you are a true expert on, which is the Federal Reserve's balance sheet policy. Jay Powell today received one question about the balance sheet policy and its quantitative tightening, namely rolling off treasuries and mortgage-backed securities from the Federal Reserve's balance sheet. It had done it at a higher level earlier this year. It's tapered, and today it announced that it will continue at the level. So it is not going to taper any further, at least for now. And Powell said that the reserves in the Federal Reserve System, namely the liabilities of the Federal Reserve and the assets of commercial banks, is ample. We are still in a ample reserve regime, and we are above the lowest comfortable level of reserves. Tough word to say. What are your thoughts on this, and can you explain further these concepts for our new audience today?
So the Fed is cutting rates today, but at the same time, it continues to shrink its balance sheet. The Fed has two tools: interest rate policy and balance sheet policy. Now, historically, the Fed always wants its two tools to go in the same direction. So, for example, when it's cutting rates, easing policy, it wants to also be expanding its balance sheet, like doing QE. And when it's tightening monetary policy, hiking rates, it also wants its balance sheet to shrink. It wants to do that because it feels like it's easier to communicate that. But one thing that's different under the Powell Fed is that, as Powell has noted, these two tools are on independent tracks, whereas Powell is willing to cut rates, but at the same time continue to shrink its balance sheet, which many perceive to be a form of monetary tightening. Now, the reason he wants to do that is because he wants the balance sheet to quote unquote normalize such that it's small enough just so that the banking sector has enough reserves. Reserves are just cash for banks to function. Now, how much cash does the banking sector needs? That's what Jack, you were referring to, low core, lowest comfortable level of reserves. The Fed wants to shrink its balance sheet so the banks have, just enough cash to function. Now, the problem is no one in the Fed knows what the lowest comfortable level of reserves is. There are a whole bunch of guesses, mottos, and things like that, but you really don't know. So the way that they look at this is that they look at market signals to know whether or not that they're close to having lowest comfortable level of reserves being breached. When they look at a number of things, one of the common things to look at is to look at balances in the reverse repo facility. As long as there's money in that facility, the Fed thinks that there's extra money in the financial markets, and it doesn't think that they're anywhere near some degree of scarcity. Another thing that they look at is just market rates. Where are repo rates? Where's the federal funds rate, and so forth? And so far, repo rates are trading below interest on reserves. Now, if repo rates were to trade consistently above interest on reserves, that would suggest that there's some degree of scarcity, and that could be a signal for the Fed to stop shrinking their balance sheet. However, the Fed right now doesn't think that they need to stop shrinking their balance sheet. They've already tapered QT, so they're shrinking it at a very slow pace. And it looks like they'll be able to continue that for at least a few more months.
A few more months. So the reserves of the Federal Reserve have been going down since February of 2024. I guess they went up a little bit. Why did they go up from February 2023 to December 2023? I know that some of that was the Bank Term Funding Program, but why did reserves go up, for most of last year?
A lot of that would be that money coming out of the reverse repo facility and going into the banking sector. What could be happening is, say, a money market fund takes money out of the reverse repo facility and buys a treasury bill. And then that money then goes into the treasury's account. And then when the treasury spends that money down, maybe to pay contractors, to pay Social Security and so forth, then that money then goes into the banking sector. So you have a lot of moving parts, but at the end of the day, the Fed, and I agree that we don't really need to stop QD. It seems like the banking sector has tons of reserves. Now, going forward, though, of course, we could get into a place where the banks become more reserve constrained. But I think before we get into that, we'll probably go into some kind of economic slowdown, and the Fed would stop QT, not because of reserves, but because they want to adjust their policy, maybe to even continue growing their balance sheet. But that's something that could happen next year rather than immediately.
Got it. So the reverse repo facility, where the Federal Reserve is technically borrowing money from banks. It doesn't, not that it needs the money. It's just so banks can have a effective deposit facility. Again, for our audience, I learned almost all of this entirely from Joseph. But that facility peaked at close to around $2.5 trillion in 2022. It has steadily been going down. So that is a measure of just how much excess cash is in the system. And it went down a lot until April of this year, but it's kind of leveled off at around $300 billion. Do you think the reverse repo facility will ultimately go to zero? And if and when it goes down to zero, will that be the point at which the lowest comfortable level of reserves level is reached, and there would be a lack of reserves? But again, I just want to reiterate for your for our audience that it sounds like you think the bigger threat is an economic threat that would cause the quantitative tightening to stop, rather than a lack of reserves.
Yeah, I agree. So I think it will get to zero. So the way that this would happen is that over time, the US government will continue to issue treasury bills, and money market funds will continue to take money out of the reverse repo facility and buy treasury bills. And as that continues, the RRP will go down and eventually get to something close to zero. Now, I remember we had a conversation with Luke Randall once, and he suggested that some money market funds, no matter what, want to invest in the RRP because they feel like it's a safe counterparty. You're basically putting a deposit at the New York Fed. What could be safer than that? And so it could be that we have a bottom of say 20, 30, 40 billion in the RRP. That's possible, but I think the trajectory continues to be lower simply because most money market funds happy to buy bills if they have a good yield over the RRP.
Got it. And I actually today had an interaction with very not money market funds, but very short term bond funds, and I actually got into some. Do you know if those ultra like 1 to 3 month Treasury bill ETFs? Not saying that that's the ones that I got into, but do they can they access the Fed's reverse repo facility, or is that only money market funds?
Only money market funds can do that. Also, to be clear, if you are an FHLB, and Jack, you've spoken to many of them, those guys have access to the RRP as well. Commercial banks can, but of course, it makes no sense for them to do that because interest on reserves is higher than the RRP offering rate.
Got it. And yes, another fascinating detail is that the actual interest rate that matters to affect policy, or where all the volume is in the reverse repo rate and the interest on reserve rate, or on excess reserves. And that what the Federal Reserve changed today, the actual policy rate, the Fed funds market kind of is a very, the volume is much, much smaller. So that's just another tidbit I learned from you.
Yeah, exactly.
Yeah. There we go. Well, Joseph, I think we're going to end it there. It's been a fascinating chance. Thank you so much for being on the first guest of Monetary Matters. You were a stalwart guest on Forward Guidance. Definitely the guest who appeared the most times, and you deserved it, not only with the knowledge that you gave me and our audience, not only with your correct calls, but your great demeanor and your great way of explaining things, your humility. So I'm really glad you were able to be our first guest today.
It's an honor to be your first guest, and I'm sure it's the first of many, many. I wish you the best in this channel, and I encourage everyone to subscribe, because I know I learned a ton of Forward Guidance, and I look forward to learning even more from Monetary Matters.
That's very kind of you to say, Joseph. Everyone watching this on YouTube should check us out on Apple Podcasts and Spotify. Very important for us to get out of the gate early on these podcast apps. YouTube kind of takes care of itself. Okay, everyone loves Joseph Wang. The algorithm feeds people Joseph Wang, but really important on these podcast apps for us to get as much traction as possible. So if you're a fan of my work, or even if you're a halfway fan of my work and you like what you see here, please subscribe to those Apple Podcasts and Spotify, wherever you get your podcast apps. Subscribe to this YouTube channel, and if you're listening to this on the podcast, it is Monetary Matters, at monetary-matters. We'll include links to all of this on the description. And of course, I'm on Twitter at JackFarley96. Joseph is on Twitter at FedGuy12, and his excellent work, which we referenced earlier today, can be found at FedGuy.com. In about 10 minutes, I'll be speaking with my second guest of Monetary Matters, Daniel DiMartino Booth. That will come out on Thursday, September 19th. So everyone should stay tuned for that. Thank you again for watching. I really mean that to everyone watching this. And I also really mean this. Thank you, Joseph, for being my first guest.
Thank you, Jack.